Okay, this is the third video, and it was going to focus on dividends and the exemptions available for those. So the first exemption we're going to be looking at is Section 10(1)(k), and you have to know the section number. And Section 10(1)(k) relates to dividends that are paid by a South African resident company. So while we don't look at the definition of dividend in EBAL 2708, in essence, a dividend as defined is an amount that is paid by a South African resident company. Now, for both residents and non-residents, that means that local dividends, in other words, dividends paid by South African companies, will be included in gross income because of paragraph K of the gross income definition. And then this exemption is available for both residents as well as non-residents, as well as both for natural as well as non-natural persons. So companies can also qualify for this specific exemption. It's not just available for natural persons. So Section 10(1)(k) starts off by saying, listen, in general, if you receive a local dividend, the full amount will be exempt. But there are two exceptions, and one of these exceptions is not on the mind map, so you'll have to add it in there. The first one says the dividend will not be exempt if it is paid by a real estate investment trust or a controlled property company. Now, a real estate investment trust is a company that is, or an entity that is usually listed on the JSE, and they primarily invest in fixed property. Now, REITs or REITs, real estate investment trusts, they have got special tax rules that apply to them. So they don't do a taxable income calculation like you would learn how to do it. For example, they've got other rules that apply to them. And one of these rules say that a real estate investment trust, if they pay dividends, they're allowed to deduct it from their taxable income. Now, for SARS, this represents a bit of an issue because if the real estate investment trust is allowed to deduct the dividend, it means it reduces their taxable income. And if the same dividend is then exempt in the hands of the shareholder or the person that receives it, then for SARS, that's a bit of an issue because now I've allowed a deduction of the amount and somebody else is also not paying tax on it. So what they try to do is to say, if the dividend is paid by a real estate investment trust, then it will not be exempt in terms of Section K, but, oh, and aren't there always buts in tax? It will still be exempt if the real estate investment trust or controlled property company, they are related to real estate investment trusts, if that is paid to a non-resident. So it's only if a real estate investment trust pays a dividend to a resident that it won't be exempt. If it's paid to a non-resident, then it can still qualify for the Section 10(1)(k) exemption. The other exception to Section 10(1)(k) that you have to know, and this is not on the mind map, so please make sure that you add it in there, is if the dividend, the local dividend, is paid in the form of an annuity. Now, I don't know if you can remember, but when we looked at Section 10(1)(h), the interest exemption for non-residents, we said the same thing. If the interest to the non-resident is paid in the form of an annuity, they can't get the full exemption in terms of Section 10(1)(h). Section 10(1)(k) has the same rule. If a local dividend is paid in the form of an annuity, irrespective of whether it's paid to a resident or a non-resident, a natural person or a company, because it's paid in the form of an annuity, you will not be allowed to claim the Section 10(1)(k) exemption. You lose it. Now, and we are going to look at this in the next slide, but please remember that dividends in South Africa, local dividends, are subject to dividends tax at 20%. And while the detail of dividends tax is done in CTA, I'm quickly going to show you what the effect will be for us in EBAL 2708. So how can dividends tax affect our paragraph K gross income inclusion and our Section 10(1)(k) exemption? Now, and you will pick this up in the homework questions, and please remember that you actually have to do those homework questions. But if a person, whether it is a natural person or a company or a resident or a non-resident, if it's a local dividend, in other words, paid by a South African company, we will have a paragraph K inclusion into gross income. However, if it is received by a South African company, right, then and there's a few requirements for it, but you can, for EBAL 2708 purposes, assume that those requirements have been met. That dividend won't be subject to dividends tax in South Africa. In other words, what we receive as the company, right, is what we will include into gross income. In other words, we don't have to scale up the dividend with 20% dividends tax. Now, the situation is different if the local dividend is received by a natural person, because natural persons, if they receive dividends from South African companies, while it is exempt from normal tax, it is subject to dividends tax at 20%, which means depending on what the information in the question tells you, if the question tells you that, listen, this is the amount that they received in their bank account, you have to think and remember that, listen, it's subject to dividends tax at 20%, so I have to scale up the amount with 20% to bring it into gross income. And the reason why we need to scale it up, ladies and gentlemen, is because gross income, listen to the word gross income. If I receive a dividend from a company, a South African company, let's say 100,000 Rand, then that is the amount that accrues to me. That is what I'm unconditionally entitled to. But SARS then jumps in the middle and says, whoa, give me 20% of that dividend. And the company has to pay it on your behalf over to SARS. But what goes into gross income is the gross amount, the 100,000 Rand, before the dividends tax was withheld, and it's then that gross amount that will qualify for Section 10(1)(k). Now, the easiest way to explain this is to show it to you in a case study, and this is a case study that's not in your study guide, right? It's a separate one. So I've given you Mrs. K. She's a 32-year-old South African resident. She received 80,000 Rand as a dividend into her bank account on the 20th of February 2019 from a local company that she had invested in 2 years ago. And we have to determine firstly what the effect of the transaction on her taxable income for the current year of assessment is, and then I'm going to show you how your answer will differ if it wasn't received by a natural person but by a South African company. Right, so this is how it works, and I need you to follow along and listen carefully. So because she's a resident, she's taxed on worldwide income, which means we will include into her gross income, in terms of paragraph K, the dividend that she received. However, because she's a natural person, she's subject to dividends tax, right? So if she received 80,000 Rand in her bank account, this means that 20%, that dividends tax, has already been deducted and withheld on her behalf by the company. In other words, she is entitled to the 100% of the dividend, so she's entitled to the full amount, but the company had to deduct a portion on her behalf and pay it over to SARS. For gross income purposes, we have to include the full amount into the framework. In other words, we take the amount that she'd received, the 80,000 Rand, and we have to scale it up. In other words, we want to get to 100%, right? So we multiply it by 100 over 80, and that's going to give us 100,000 Rand. Now that means for gross income, we include 100,000 Rand into gross income, and we exempt 100,000 Rand, right? So for normal tax, she's not going to pay normal tax at the sliding scales on this amount. Why? Because she was already subject to dividends tax at 20%. Now, if this was a company, then our answer will, to a large extent, look the same, but also not, because it's a resident taxed on worldwide income. Now, because it's a company that receives it, a South African resident company, they usually have no dividends tax that is levied. And for EBAL 2708 purposes, you can assume that if a South African resident company receives a dividend, that it was not subject to dividends tax. So whatever it is that they receive, that is what they will include, which means we will include the 80,000 Rand into gross income, and we will exempt the 80,000 Rand in terms of Section 10(1)(k). We don't have to scale up with dividends tax because the company was not subject to dividends tax. Now, ladies and gentlemen, the purpose of this additional case study is not to confuse you, but I have picked up in the homework questions that they do sometimes give amounts excluding dividends tax or including dividends tax. Now, the information in the question will usually be clear. You just have to know that if it is a natural person and they give me the amount of the dividend net of dividends tax, to determine what goes into gross income, I have to scale up the dividend. If they give it to me prior to the deduction of dividends tax, in other words, the gross amount is given to you, that's the amount that goes into gross income. If it's a South African resident company, then you will not have to scale up with dividends tax because they are usually not subject to dividends tax. If it's a non-resident, non-residents are also subject to dividends tax if they receive it from a South African company. So just keep in mind, whether it's a natural person or a non-resident company, we're going to treat them the same as we would, any other natural person, i.e. determine if dividends tax needs to be included to determine our gross income inclusion. If you are confused about this, right, make sure that you work through the homework questions. You'll see how they do it, and then post a question on the discussion board on Blackboard. Right, so one of the exceptions we spoke about was if the dividend is received from a real estate investment trust. I just want you to make a note, 8.18.2 in SABA, there's a heading taxable dividends from a right, and then there's 2 additional headings below that. You can leave the following heading, normal tax consequences for the right. We only focus on the normal tax consequences for the shareholder, and I want you to go to your SABA and open up at chapter 8. We're going to look at example 8.20. So SABA example 8.20 says we've got company A, who's a REIT as defined. For the current year of assessment, the company received taxable rental income of 100,000 Rand. The full 100,000 Rand was distributed to company B, a resident as defined, and we have to determine the tax implications. Now, important, for EBAL 2708, we don't look at the implications for the real estate investment trust. Our focus is going to be on company B, the shareholder. Now, because company B is a South African resident, that dividend is going to be included into taxable income by virtue of, let me just write it in there for you, paragraph K. Because it is a local dividend, I'm going to ask, does it qualify for the section 10(1)K exemption? And the answer is no, because it was distributed by a REIT, Real Estate Investment Trust, sorry. If company B was not a resident, in other words, a non-resident, then it could still have qualified for the section 10(1)K exemption. Right, and ladies and gentlemen, that concludes local dividends. I'm going to make a separate video for foreign dividends. That will be up next.